One of the transactions that I worked on was the first SPAC. Hi, I'm Bob Brown. I'm the CEO of ClearThink Capital. For 21 years prior to founding our predecessor firm in 2009, I was a lawyer, and one of the transactions that I worked on was the first SPAC. As part of that, I and a gentleman who was on a similar transaction that took place simultaneously went back and forth with the SEC and actually negotiated what ultimately became Rule 419, which is the rule on which SPACs are based. SPACs are attractive to IPO investors because they give them the opportunity to participate with a talented management team in seeking an acquisition, but it still gives them the right to get all of their money back if they're not satisfied with the transaction for any reason. So from their standpoint, it's a very low-risk proposition as opposed to investing in IPOs generally. As a SPAC approaches its business combination, in their proxy statement, there are generally two questions. One is, does the IPO holder vote in favor of the acquisition or against? And secondly, do they want to redeem their shares, or do they want to continue to hold their shares? If they vote to redeem, they can get their money back plus interest. That interest is generally treasury. If you buy in the IPO, there's no way for a SPAC investor to lose their money. Your worst case scenario is you would have purchased a $10 unit. That $10 would have sat in trust for the duration of the SPAC, and on redemption, you'd receive $10 plus interest. For a company to be a good SPAC candidate, they should have a solid business, they should have great visibility on their growth, and they should be able to use the capital that is going to be available upon merger with the SPAC. Ideally, there should be a high arbitrage between the private value of the company and the public value of the company, and that company should be valued at a minimum at 3 to 5 times the amount of cash that's in the SPAC at the time of the business combination. A corporate SPAC is a SPAC where a corporation, an existing corporation, is the exclusive or nearly exclusive sponsor. They're in essence using it as an acquisition vehicle to take themselves and another company that would otherwise be merging into the SPAC and merging the two into the SPAC simultaneously. It becomes in essence an acquisition vehicle for both companies. SPACs trade at around $10 generally because that's the purchase price. So what people are anticipating, what the investors are anticipating, is receiving their money back plus interest. Certain SPAC teams, particularly those that are highly experienced and highly successful in the past, may find that they traded a substantial premium from that $10 because they have a history of consummating transactions. SPACs could trade below $10 if the general public feels that they don't have a high degree of confidence in the ability of the team to consummate a transaction. In that case, you see it trade at a discount to reflect the accrual of interest and what everyone would anticipate they would receive on redemption. SPAC sponsors are providing the risk capital for the SPAC to engage in the IPO, to stay in compliance post-IPO, and for the additional costs relating to a business combination. In exchange for that, they get a 20% equity carry in the SPAC, plus some additional securities on the basis of the amount of sponsor capital that they contribute. As far as the kinds of returns they can expect, they're buying at a very substantial discount to the public price. And even within the sponsor, there may be different groups that have paid different amounts based on their level of participation, whether it's management or they're an institutional provider, or they're just a passive outside investor. The SPAC market today is very hot. It's a wonderful alternative to traditional IPOs. The structure's being used in more and more contexts, whether in the corporate context for regular SPACs. There are other permutations and combinations out there, and it's developing to have a more wide-ranging usefulness. Going forward, I think you'll see the SPAC sponsor structure to vary in size on the basis of the performance of the underlying assets post-business combination. You also may see the sponsor size shrink over time. There are some practical limits to that because you need to have enough incentive for the sponsor to provide the risk capital. So you can't go too high and still have that incentive.